As of the market closing on June 11, 2026 at 4 p.m. EST, Nokia stock is sitting at $14.09 per share, marking a significant intraday surge of 5.15% during normal trading hours, with an extended upward drift to $14.45 in the after-hours session. The New York Stock Exchange is currently closed since today is Friday morning in New York and normal market hours have not yet commenced for the June 12th session. This sudden 5% leap represents a dramatic breakout above its typical trading range, catching many standard retail investors completely off guard. While casual observers might assume this jump is just a minor ripple tied to general tech market momentum or standard telecom infrastructure cycles, the underlying options chain dynamics reveal something far more calculated. Institutional traders are quietly positioning themselves for a massive restructuring of hardware infrastructure that stretches deep into data center connectivity. Millions of dollars are shifting behind the scenes, indicating that the traditional perspective on this legacy business is fundamentally missing the mark. The expectation for Nokia stock has always been somewhat uninspiring, with the average retail investor viewing it as a slow-moving, low-margin telecom legacy player that is trapped in the cyclical and incredibly expensive build-out of cellular infrastructure. People look at it and think about the equipment mounted on cell towers, or they remember the early days of mobile hardware, believing the firm is stuck fighting low-cost global competitors in a race to the bottom for 5G contracts. This common ground narrative sets a low bar, convincing many that the stock is a defensive, stagnant dividend play at best. However, the reality completely challenges this perception. Institutional heavyweights like FMR LLC, which recently added over 57 million shares to its position, are realizing that the enterprise is quietly securing a foundational role in the physical architecture that powers high-speed artificial intelligence networks. The market is beginning to price in its high-performance optical networking components and specialized defense infrastructure, creating a sharp disconnect between what the public expects and what the financial statements are starting to reflect. Analyzing the recent market action reveals a massive wave of volume and institutional positioning that validates this contrarian perspective. The stock has broken well out of its historic multi-dollar rut, driven by a surge in options volume, where call options are heavily outnumbering puts. Specifically, the near-term options chain showing an implied volatility spike of over 77% proves that massive players are betting on sustained upward volatility rather than a temporary spike. When a stock like this moves over 5% in a single session on heavy institutional backing, it usually means the smart capital is front-running major contract structural shifts before they hit mainstream headlines. Major firms are allocating massive blocks of capital towards this asset through self-investing channels and institutional wealth accounts because the risk-to-reward ratio has tilted favorably. This institutional accumulation is happening at a time when retail traders are distracted by headline-grabbing megacaps, allowing larger funds to lock up massive blocks of equity without causing an immediate parabolic spike. To understand why this is happening right now, you have to look closely at the macroeconomic environment and the ongoing pressures across the entire tech sector. High interest rates have historically made it difficult for regional telecom carriers to finance major network overhauls, which squeezed infrastructure suppliers for consecutive quarters. This macroeconomic headwind forced a massive internal cost-cutting strategy, optimizing corporate margins and creating a lean financial foundation. Now, as corporate capital expenditures across the technology sector pivot aggressively towards back-end infrastructure, the demand for ultra-low latency optical transport networks is skyrocketing. It turns out you cannot build massive distributed computing clusters without the highly complex optical switches and routing equipment that this enterprise specializes in. This reality has completely flipped the script on earnings expectations, causing recent quarterly reports to show surprising resilience in gross margins despite flat top-line growth in traditional cellular markets. If you look at how people manage their portfolios today, whether they use specialized tools like Schwab Intelligent Portfolios for automated asset allocation or prefer direct hands-on online investing, a name like this rarely pops up as an aggressive growth vehicle. Most self-investing strategies tend to focus exclusively on software or semiconductor giants when looking for technology exposure. But smart wealth managers look for asymmetric opportunities where the downside is protected by hard physical assets, a massive global patent portfolio, and a steady stream of recurring software licensing cash flows. By choosing to invest online through an individual brokerage account, sophisticated investors can buy into an asset like this at a fraction of the valuation multiples seen across the rest of the technology landscape. The sheer contrast between a price-to-earnings ratio that has historical anomalies and the massive underlying asset value is exactly what catches the attention of deep value funds looking to outperforming automated algorithms.
Let's establish some direct common ground here and look at what the broader public thinks about telecom infrastructure. Comment below how many shares of Nokia stock you currently hold in your portfolio, or if you prefer sticking to the megacap options. The general public tends to look at alternative high-yield sectors or highly publicized tech stocks on major investing sites when they want growth. They open up an individual brokerage platform, look at the historical 5-year chart, and assume that since the stock has traded within a narrow band for years, it will stay there indefinitely. They rely heavily on standard automated screeners or basic online investment help that categorizes this company as a legacy communications utility. This passive approach completely misses the subtle shift in product mix, where high-margin network software and advanced optical security systems are slowly replacing the low-margin, high-labor physical installation services of the past. To get a clear picture of how this entire ecosystem operates, we need to examine the business model and the core mechanics of what the enterprise actually does today. The business is fundamentally divided into distinct segments, with mobile networks, network infrastructure, and cloud network services forming the core operational pillars. The mobile network division focuses on providing radio access network technologies for mobile operators globally, which is the traditional business model that most people recognize. However, the network infrastructure division is where the hidden value lies, encompassing optical networks, IP routing, and subsea cable systems. This division provides the actual physical pipelines that connect massive data centers across continents and oceans. Additionally, the company owns Nokia Technologies, a massive intellectual property engine that controls thousands of essential patents for wireless communication, generating pure high-margin royalty income from almost every smartphone and connected device manufacturer globally. Looking back at past performance and older financial reports, the organization went through an incredibly painful period of corporate reinvention after its historic departure from the consumer mobile handset business over a decade ago. It spent years absorbing massive acquisitions, refining its supply chains, and pouring billions into research and development to ensure its proprietary silicon chips could compete with global rivals. Older quarterly results often showed heavy restructuring charges and squeezed cash flows that frustrated long-term investors, leading to a prolonged period of underperformance where the asset was heavily shorted by funds who believed it would never recover. This historical baggage created a permanent cloud of skepticism around the name, which explains why the current valuation remains so suppressed even as the underlying fundamentals began to turn around over the last few quarters. The market treated the stock as if it were still trapped in its old structural deficits, completely overlooking the clean balance sheet, rising cash reserves, and the steady reduction in total debt. This historical skepticism brings us directly back to the tension between expectation and reality that defines the future outlook of the stock. The expectation is that the company will continue to coast along, tracking the slow, predictable capital expenditure budgets of major telecom carriers. The reality is that the enterprise is entering an entirely new structural catalyst phase, driven by enterprise private networks and industrial automation. Large-scale manufacturing plants, global logistics hubs, and national defense agencies are completely bypassing public cellular networks to build their own private, highly secure wireless environments. This company has quietly captured a dominant market share in this rapidly expanding private network niche, selling end-to-end hardware and software solutions directly to corporate giants and sovereign entities. This enterprise segment operates on much higher margins and features stickier multi-year service contracts than traditional consumer carrier deals, completely rewriting the long-term profitability profile of the business. When evaluating how to play this development, modern traders have an incredibly diverse set of options available through various platforms. Some choose to execute short-term option strategies through a sleek Robinhood stock trading setup, taking advantage of the low-cost structure of the Robinhood app to capture quick percentage swings in premium. Others utilize a Robinhood investments approach to build a long-term position through Robinhood fractional shares, treating the stock as a foundational value anchor alongside their more volatile holdings. Those who prioritize comprehensive financial tracking might look at their positions alongside a Robinhood cash management account to balance liquid capital with tactical equity exposure. At the same time, many retail investors use multifunctional apps like SoFi to handle their active portfolios. Using a SoFi Invest account allows a user to smoothly transition between automated wealth management and aggressive individual stock selection. Whether utilizing SoFi Investing for long-term compounding, trading SoFi stocks manually, or checking the latest macro trends on the SoFi Active Investing interface, the goal remains identical, which is finding structural value before the wider market corrects the mispricing. For institutional players and highly sophisticated retail traders, the execution strategy requires a much more robust setup. This is where advanced tools like the Interactive Brokers platform or a specialized fidelity trading platform become absolutely essential for executing complex block trades. Larger accounts rely on Interactive Brokers stock trading to access global liquidity pools and secure precise fills on high-volume limit orders, especially when managing foreign exchange risks across multiple international listings. The ultra-low Interactive Brokers fees and advanced risk management tools allow professional traders to hedge their equity positions with deep-in-the-money options contracts without eating into their baseline arbitrage margins. Similarly, long-term capital preservation funds often route their volume through traditional pillars like Fidelity Investments, holding the underlying shares within managed individual brokerage accounts or structuring tax-advantaged positions across a suite of Fidelity IRAs to compound the steady dividend distributions over time. As we project forward into the coming quarters, several distinct catalysts and structural risks will dictate whether this asset can maintain its newfound upward trajectory or if it will slide back into its historic range. The primary opportunity lies in the rapid acceleration of back-end infrastructure upgrades required by massive web-scale cloud providers who are running out of data center capacity. As these tech giants build next-generation facilities, the demand for highly specialized optical routing technology will act as a major tailwind for the network infrastructure segment. Furthermore, any additional monetization of the company's massive patent portfolio through new licensing agreements in the automotive or Internet of Things spaces could provide immediate high-margin cash infusions directly to the bottom line. The expectation that growth is tied solely to traditional cell tower installations is about to collision hard with the reality of an enterprise software and data routing boom. However, an objective analysis requires weighing these opportunities against prominent operational risks. The telecom sector remains highly sensitive to geopolitical tensions, and any disruption in global semiconductor supply chains could immediately delay hardware manufacturing and push out project timelines for major clients. There is also the constant threat of intense pricing competition from regional competitors who are willing to sacrifice margins to secure long-term market share in developing economies. If macroeconomic conditions deteriorate significantly, corporate enterprise clients might freeze their private network budgets, which would slow down the high-margin growth segment that bulls are currently counting on to expand the valuation multiple. Investors must closely monitor whether management can maintain its strict cost controls and continue to expand operating margins even if top-line revenue growth experiences temporary regional headwinds. Ultimately, this market narrative provides a masterclass in how institutional positioning can quietly diverge from retail perception. While the general public relies on surface-level screeners on basic investing sites that label the business as an underperforming legacy technology asset, sophisticated funds are utilizing advanced platforms to accumulate shares based on a completely different set of structural fundamentals